Just so we are all on the same page, dividend is the money paid regularly by the company to its shareholders or its owners, and it's typically distributed quarterly. Many people chase dividends for passive income. This means that people specifically look for companies that pay dividends so that they can purchase ownership of their companies and able to receive recurring incomes without having to do additional work. This is a way to make our money work for us. Sounds great so far, right? Pay money up front in exchange for ideally an infinite quarterly income. But here are the issues. Well, it could work out for some, like retirees who just want to park their money somewhere and get regular payments that they can use in their day to day lives. It's really not an ideal strategy to invest, and here is why. A lot of companies know that people love receiving dividends. So, to get investors to invest, some companies end up borrowing money just to keep up with paying dividends, which could be disastrous for the business. This reminds me of a person buying gifts for their loved ones using credit cards, hoping that one day they will have the money to pay it all back. Hope without an actionable plan is gambling and definitely not investing. So, the lesson to be learned here is to make sure that the company's dividend is sustainable. How, you ask? Great question. Let's look at an example. From 1962 to 2019, Disney paid dividends every single year to its shareholders. But when COVID hit and Disney parks and cruises shut down, Disney decided to stop its dividends, and rightfully so, to save the business. The problem was that those investors relying on recurring payments suddenly lost passive income. Let's actually look into Disney's financial situation during this time period. Cash from operations was slashed in half from 12 to 14 billion to 6 to 7 billion. Their free cash flow, which is what's used to pay dividends, went down from 9 billion in 2018 to 1 to 3 billion in 2019 to 2022. In 2023, it is still only 4 billion, so it has been a few years that Disney has not made dividend payments because they haven't gotten back to their previous profitability levels. If you're one of those investors that were counting on those dividend payouts, then you have been SOL for a few years. Let's look at another example of how to spot a company that might not be able to sustain its dividend payments. Walgreens is one of the largest retail pharmacy chains in the US. Remember that dividends are paid from the company's free cash flow. Using Yahoo Finance data, if we take a look at Walgreens' free cash flow for the past couple of years, it has been declining. In fact, in 2023, its free cash flow is down to 141 million, yet the company has continued to pay over 1.6 billion in dividends. You might say that this is just an anomaly and they should be able to bounce back, and you might be right. But if you're an investor that is purely chasing after companies that pay dividends, I would be asking if this is sustainable. Furthermore, dividends are less tax efficient. They are subject to double taxation. They get taxed at the corporate level and then at the individual shareholders level. Companies pay corporate income tax on their profits. After tax profits are what's available for distribution as dividends. When shareholders receive dividends, they are taxed again on that income at their individual tax rate. So instead of paying dividends, it is usually better for companies to use their free cash flow or after tax profits to continue to grow the business, buy back its own shares when it's cheap, pay the company's debts, or reinvest the money, which are more tax friendly and beneficial for all parties in the long run. When a company has matured and is unable to find better ways to use its free cash flow, then issuing dividends becomes an ideal strategy. At this stage, it's probably better for the company to give back the money to its shareholders to grow their money on their own. So, our key takeaway here is if an investor only focuses on finding companies that issue dividends, they may miss out on companies that are actually using their free cash flow wisely. Either that or they can fall into companies that do issue dividends but are not financially stable, which are also known as dividend traps. The next time that anybody suggests a stock to you because of a company's high dividend yield, make sure that you forward them this video and say, "Don't fall into a dividend trap." Watch this next video to learn a better strategy on how to find great companies to invest in.